Koul is with us. He's equity strategist, Asia Pacific at Goldman Sachs. Sunil, great to have you with us here. Good morning. Thanks very much for your time. You know, great 2023, actually great last 2 months of 2023 as well. And the start to 24 has not been bad. It's not been a great flying start, but January seasonality perhaps at play. What's your overall sense though? You know, should one head into this year with slightly lower expectations, or we could have a repeat performance?
Yeah, Prashant. I mean, first of all, Happy New Year to you and the team there. I would say, look, I think the markets have started the year a little bit soft, as you said, but that's probably sort of the region across the trend across the region, right? I think what's happened in the last couple of months is that the macro environment, as we all know, has shifted a lot, right? So we have better US growth, easier start to the Fed rate cuts, possibly easier start to the Asian central bank cuts, dollar backing off, and so I think the markets have kind of priced all of that a little bit too quickly, and that seems to be kind of partly in the price. And so what we are seeing in the first trading week, at least of the year, is some of that is getting a bit unwound. But I think our overall sense for the market for the full year for India is that we remain structurally positive on the market. I think one of the things I wanted to mention is that if you look and if you talk to people generally say that Indian equities have done very well last year, 20% returns for the market. But I think what's less known is that if you look at the 20% return for the market, it was all earnings led. So 18% out of that 20% was actually earnings accrual. And so we did not actually see much change in the multiples for the market. So it's a good fundamental rally for the market. Overall, we think this year we could see Nifty hitting 23,500, which is about 9% upside from current levels. But I think the maths for us is that we think earnings will grow about 15%. And even with multiple derating or compression in our numbers, we think you can still sort of see decent upside for the market overall.
Hi, Sunil. Welcome to the show. Nigel on this side. That's an important point you make, right? Everyone looks at the P and says that the Nifty went up 20%, but the earnings as well kept pace. So the P was more or less intact, which is pretty good news. Sunil, the last time we chatted, you were telling us that, you have increased allocation to India. At current reckoning, what have you all done of late? Have you all added, or, it remains one of the top markets that you like, but what's the view from here on?
Yeah, Nigel, we are overweight the market. So we stay overweight India. So we have other parts of the other markets in the region where we are overweight in, notably sort of Korea, Japan, and China. But India also is there in our pecking order, right at the top, with one of the strong overweights there. I think the difference is India for us is a structurally overweight market, but I think for some of the other markets, some of them are much more deeper cyclical and are coming in from much lows. So there is a cyclical pickup in those markets. But as I said, based on our return expectations, we do think India should be a market that will continue to perform well this year.
Okay, Sunil, hi, morning. Good to have you on the show. So since your overall, sense in the market is still optimistic, in terms of the construct of the portfolio, to what extent would you go with the themes of 2023? I mean, industrials, capex, PSU stocks, defense. These were the big sort of trades or the big investment themes of the previous year. Are they still good for more?
Surabhi, that's a great question. Look, I think in terms of the portfolio construction or in terms of themes, we do think there will be some things that will shift, right? So if you look at it from a sort of styles lens or a thematic lens or a factor lens, as we all know, I think the big trade for last year was sort of a rally in small and mid caps, and large caps were sort of laggards, right? So one of the strong views we have for this year is that we do think large caps outperform small caps. And so one of the sort of the ideas therefore we have is kind of look for companies that are large cap, that have good fundamentals, but that have lagged the broader market. So I think that's one pocket, and I'll come to the sectors in a bit. But the other shift we are expecting is that of quality. So if you look at the quality styles, for example, strong ROE companies, strong balance sheet companies, those actually have been laggards in the last couple of years. It's value that has done better. So we also think this year it will be sort of quality companies coming back. Obviously, you have to think a bit about valuations. So for lack of a better word, we're kind of looking at a GARP approach, so quality at a reasonable price. So the companies that are sort of giving you decent earnings and revenue growth, as well as have strong ROEs north of 15%. We like those companies. In terms of sectors, our overweight are banks. So that was a laggard last year, but we think that should perform well this year. So that will be a change. We also like autos. And in addition to that, we have industrials. I mean, that one you can say, obviously, they have done well, but we think on a more medium-term basis, it still makes sense to be in the industrials or broader manufacturing cycles, given the benefits from PLI and the broader shifts in the supply chains across the region. And then we also have overweight on utilities, which is more a call on India trying to kind of grow at the same time kind of trying to decarbonize. So we do think that as we continue to hit some peak power deficits in the economy, you will see some of the legacy sectors, thermal, continuing to re-rate, and at the same time some more improvement on the energy efficiency side, on the renewables. So I think, therefore, banks, industrials, autos, and utilities will be the four pockets where we are most constructive on at this point in time.
No, got that. Sunil, we'll get back to some of these individual sectors, etc., in a bit. But I just wanted to get a slightly broader view from you. I mean, you guys at Goldman Sachs pretty much talk to all the large investors around the world. When we talk about allocations and a market which is poised for takeoff and many years of steady growth, etc., how much of the sort of investable money equity assets are already here, and how much is yet to make their first kind of allocations to India? I mean, I don't know if you've done any work on that.
No, I think
because if you're not here, then irrespective of the price, you'd want to be here, right? You'd want to make
that's
an
a great
allocation.
question. Look, I think the narrative out there generally is that given India has done so well, I mean, as we all know, it's been like 8th straight year of positive performance for Nifty, right? So it's been a great compounder in the region. But I think the narrative out there is like, look, I mean, India is super crowded, it's expensive. But if you sort of talk to people, I think the general feeling among a lot of investors, at least last year, was people kind of missed the broad rally in the markets. Either it was because of high valuations or it was because of the elections. And obviously the rally was more concentrated in mid and small caps. So a lot of the clients we have been speaking to, they have broadly missed the rally and sort of very keen to increase exposure. But when you also look at the data, it's very clear that people are not, the positioning is still overall quite conservative, right? So just to give you a couple of stats. So for example, if you look at emerging market investors, their overweight allocations is around 100 basis points during the peak. Historically, that's been as high as 500, 600 basis points versus the benchmark. So the overweights are much lower than what they were in the history. If you look at the global long-only funds, they are still underweight India. If you look at the aggregate foreign ownership for the Indian equities, they're towards the bottom decile of its last 10-year range. So whether you sort of talk to people anecdotally or whether you look at the hard data, it's quite clear that there is more allocations that could increase, and people from our conversation, as I said, are very keen to increase the allocations. Because as you said, Prashant, if you look around, it still feels like most of the larger economies, you're seeing slowdown in growth. So growth is sort of slowing in US. We have Japan slowing, we have China slowing, we have some of the other larger markets in the region, including Australia slowing as well. So India still looks a market where macros are very stable, earnings are growing, and you still got decent sort of growth. We are looking for example, 6.2% GDP growth next year and this year. So across the region, it still looks like a structural place to be in, and so we think, therefore, foreign money should continue to come into the market, especially post-elections as well.
Well, Sunil, that'll be music to the ears of all the investors and our viewers as well, that India continues to remain a structural theme and standing out within the pack. But what about the central bank? Everyone's debating on what the Fed is going to do. What kind of action are you all anticipating from our central bank? That's the RBI, which has done a very, very good job in the last few years. Are you all factoring in rate cuts from the RBI, or are you all not in that camp?
No, we are factoring rate cuts, Nigel. So just to be transparent, so our Fed call as well as India call actually has shifted somewhat in the last couple of months. So we were expecting the Fed cuts to start in Q4 of this year. That was before the December policy meeting. But after the dovish tone from FOMC, we are now looking at Fed cuts starting as early as March. So we have actually 5 Fed cuts baked in our forecast for this year. I think the market is somewhere around 6 to 7 cuts. So a little bit dovish than that. But we have rate cuts from Fed. For RBI, we were actually looking for rate cuts to start in Q4, which is kind of in line with higher for longer view before. We have also front-loaded that. So we're now looking for 2 cuts from RBI in Q3 and Q4. So cumulative 50 basis points rate cuts. So the repo rate goes from 6.5 to 6. But I think the one thing to note there would be that we do think that in terms of the sequencing of the easing, you probably start off with sort of easing the liquidity in the banking system. That probably comes more in Q1, Q2. Then probably they shift the stance, which is currently withdrawal of accommodation, to more neutral or accommodative sometime in Q2. And then, as I said, Q3, Q4 is where we're expecting cuts. So overall, sort of easing, but the easing starts through easier banking liquidity and then from the rate cuts.
Okay, got that. So rate cuts will obviously make the market really happy. Sunil, I'm just going to go back to that point that we were discussing on the portfolio construct side, specifically 2 sectors that you named, industrials and utilities, because here stock prices have rallied quite a bit. As I said, there were themes of 2023. So A, how do you find valuations today vis-a-vis, the long-term averages? Are you still comfortable? And B, what would the next round of sort of kickers be? In terms of execution, for instance, where are you expecting a better pickup? And what is it that could still drive these stocks another 20, 30, 40% higher, given that many of them have been doublers or maybe even trebled in the last 12 months?
Yes, sir. We are aware of the valuations being a little bit expensive. So if you look at the broader manufacturing sort of cohort, sort of include not just industrials, but industrial, cement, real estate, as you said, utilities, the broader sort of investment cyclicals, we have indeed made some changes recently to the overall allocation. So for example, we actually took cement down from overweight to neutral. And so we do like cement longer term. It obviously plays into both the real estate recovery cycle as well as the infrastructure. But the fact, to your point, the fact that sort of in the last couple of months, the stocks went up 15% plus, and the next couple of quarters, probably volumes are going to be much more muted. We do think that the absolute upside on a more tactical basis is not going to be there. So that's why we kind of neutralized it. I think for the industrials overall, even though the infra-related names, the order books could be muted because of the election cycle, I think the broader industrials, the reason we stay overweight that camp is because there are other segments. For example, you have the logistics segments. There is the broader structural theme of kind of unorganized to organized shift, which we are seeing. There is also kind of better execution we are seeing, for example, in the EMS segment because of the PLI. So I think there are sort of micro stories which are definitely benefiting the individual stocks. And so on the bottom-up basis, we do think the industrials therefore sort of makes sense. There is obviously transportation, which is airlines also in there. So it's kind of a mixed bag. And some segments we like there, which is the reason for being constructive there. I think the thing you sort of partly sort of alluded to, we do require the private capex cycle to come back, and that is our expectation that post-elections we do see some of that improving, and if that improves, that probably could give another leg of sort of rally to some of these stocks. So I think that is a part of our expectation at this point in time. So I think that's something I would point to. I think for utilities, as I said, it's a function of sort of demand supply. We still think, given the demand for power is still very strong, and even though India is trying to decarbonize, it will take some time, which means that in the near term you continue to run into deficits. In which case, for example, some of the thermal related stocks that can continue to see re-rating. They have done well, but I think relative to the broader market, if you look at valuations, they are still sort of inexpensive. So we think there is still further room for some of those areas to re-rate. And then I think we also, as I mentioned, expect more progress to happen on the renewables side, especially given the cost for solar has come down. So we think there is more more to run up in those sectors. Because if you sort of rank these sectors relative to other bits of the market, especially some of the consumer discretionary bits, utilities still screen out much cheaper.
Okay, well, that's a very comprehensive sort of rationale for why you're expecting some of these big themes to continue perhaps performing and, more micro opportunities within the larger complex as well. Sunil, great talking to you this morning. Thank you very much for joining in. And we look forward to more conversations during the course of the year.